Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside of the S&P 500 to look at other indexes, other sectors within the stock market. I also look at some other markets that are traded actively because sometimes these markets can have an impact on stocks in general and the S&P 500 more in particular, and even more in particular on individual stocks that some of you may own. And so looking at what's happening in some of these other markets may have an impact on some things. This is being prepared for Tuesday, December 26th. The first area that we look at is S&P 500 valuation. And we look historically to see how our current prices based on earnings that have already been released. And then we look forward to see how our prices right now related to the current projections that analysts are giving to look forward at earnings. The first area in here is we just show the S&P 500, which is in black, and then we have a PE ratio of 10, 15, and 20. These are static numbers, and typically when we're at 10 or below, the market is considered to be inexpensive. At 15, we're fairly valued. 20 or above, we are considered to be expensive. And right now, as we've seen for a long time now, many years, we are expensive on a historical basis. The black line is the S&P, the red dashed line, that's the PE ratio of 20. To give it a little bit closer look, we take the PE and subtract the S&P 500 price, and that gives us a positive result, and that means that we are currently expensive. We can also look at this historically to see other events that have happened and what the valuations were at that time. We also can look at another way of analyzing this through a thing called the Shiller PE ratio. You may also hear that referred to as CAPE, C-A-P-E. This looks at an average over a period of time, and it was developed by Robert Shiller. Right now, we're getting a reading of 32.16. Well, to give us some context, we can look at a historical chart, and we're pretty high when you look at other events that have happened, like the 1929 crash, like the 1987 crash, and so forth. But we can also look at the median and the mean here, which is between 16 and 17. And since we're at 32 right now, we're almost double what the median and mean price has been. So on a historical basis, this also suggests that we are overvalued. But the market doesn't do that. And I don't have access to the same charts that I used to have access to. This works more on analyst projections and forecasts. We still use that 10, 15, 20 scale, but right now we're coming in with a PE ratio looking forward of 21.36, which is a little bit above that 20 level. So we are looking a little bit expensive. We also look at growth versus value. Growth is when we want to buy low and sell high. That's when the indexes have a tendency to really go up when growth is doing well. Value tends to hold up better when the market's going sideways to down. In 2022, value did better. In 2023, growth is doing better, but we want to look at the comparisons between the two. First of all, we look at what's called a pure growth index, and we are seeing a recent golden cross here as the growth index has been showing some improvement. Then we look at just the value index, and this is still in a downtrend, but this has also been showing some improvement. What's interesting is when we take a ratio between the two, and this is a little bit of a concern right now, where we're seeing the growth to value ratio, it's still in an uptrend showing that growth is outperforming, but we've really been coming down over the last few months. And we don't want to see that. We want to see this ratio really going up to give us more confidence in the stock market. And then we look at an inverse of that same chart, which just flips everything right upside down. And we look and see where value is underperforming growth, but it has been bouncing back. Now, the reason for these additional charts and flipping things around is because these are calculated in different ways. There are indexes, there are ETFs, there's different ways of looking at this, and we want to make sure that we're seeing the same thing in all different environments that we look at. This is an ETF of the growth to value ratio, showing that we're still in an uptrend, but we have been falling back. This is an inverse, showing that value has been underperforming, but has been bouncing back up. This is the peer growth to value index longer term, showing that we're still in an uptrend, but it has been declining. And this is looking at value to growth, also showing that value has been showing some improvement, even though it has been underperforming. We want to keep an eye on this. Also, we look at another growth index, the value index, showing that growth has been starting to show some weakness, even though it's still in a longer term uptrend. We also measure growth in a little different way, and this is a little more positive. This is the growth to value ratio where we're still hanging in there. We're not really breaking out, but we are showing some improvement on this chart, where we're also showing on the next chart where value continues to underperform. We look at small cap growth to value, and this has been a little bit disappointing. We've been seeing a real bounce in the small caps, and in the month of December, we tend to see this thing called the January effect. There's no guarantee this is always going to happen, but at least up to the point of recording this video, it looks like it is happening, where small cap stocks and even mid cap stocks tend to have more favor, and they call that the January effect, that ends up going into the next year. And we can see that the index has really been showing a lot of improvement going back to the beginning part of November. But when you look at the growth to value ratio, we still continue to chop sideways. And in fact, with this ratio, we're now seeing a recent death cross here. But when we look at mid-cap growth to value, it's more encouraging. This is starting to break out of this recent range as the index has been going back up. We want to see this stronger than it is, but it is looking better than when we look at the small caps. Then we look at S&P growth to value and take a ratio of that, where this is continuing to go down as the index has been going up, and that is a warning sign, and I've been talking about that in the daily videos. We also keep an eye on inflation. This is a monthly chart of the CRB. This is the Commodity Research Bureau Index. These are different commodities, and as they're going up, that tends to be inflationary. When they're coming down, that tends to be more deflationary, and this is still continuing to come down. This is a monthly chart, so it takes a while for this to change, but we are below the moving average. Then down below, we take a ratio of the inflationary areas of the CRB and the deflationary areas of the CRB, and we are showing some improvement here, but we're coming back up to the moving average, but we're still below that. If this really started to fall, that would actually be a concern. That would be more deflationary than inflationary. The fact that this is coming back up a little bit for right now shows that inflation is not a real problem, but deflation doesn't seem to be a real problem either. I'm going to look at just the CRB index. This is a daily chart where it's still in an uptrend, but it's a weakening uptrend as price is dropping below both of the moving averages. We look at the Baltic Dry Index, which is how much does it cost to ship products from point A to point B in the Baltics. And this had really been spiking up as some geopolitical events were unfolding. Now it's starting to come back down, but it's still in an overall uptrend, and that could be inflationary. Then we look at some other markets just to keep an eye on these. We just look at them every week here. Aluminum, which is in a downtrend, but it has been bouncing up. Corn, which is also continuing to be in a downtrend. Wheat has been bouncing back up a little bit, but is still in a downtrend. We keep an eye on fertilizer, which continues to be going down. Oil, which is bouncing all over the place. It spiked up when things really started to go crazy in Israel. Well, since then, it's been settling down a bit. We got up to 95. Now we're at 73.56. Gas continues to be in a downtrend, which is probably something we all appreciate. We look at diesel, which is also continuing to decline, which also doesn't add extra cost to things that are being shipped. Heating oil continues to be in a downtrend. Well, it's in an uptrend, but it is falling down right now. Natural gas has been coming back down, even though it's still in a longer-term uptrend. And copper, this could actually be somewhat positive. We're seeing copper start to rebound a little bit. We want to see it go higher than this, but as the markets are shifting from this idea that the Fed is raising interest rates over to this new idea that maybe the Fed is done raising rates and possibly in 2024 will be cutting rates, the economy is still hanging in there for right now. And when the economy looks better going forward, copper tends to do better. Then we take a ratio between copper and gold. When the economy is doing better, copper outperforms. When the economy is having problems or there's a lot of geopolitical events, gold tends to outperform. And we're pretty much going sideways right now, but we're still above this moving average when we take the copper to gold ratio. Then we look at a longer term chart. That's the black line where this has been declining as the economy has been under some pressure lately. And to get some perspective, we also plot the 10-year yield in red, which has been declining, and the 2-year yield, which is in green, which has also been declining. But these are still quite far apart from each other, and they've been that way for a couple of years now. Typically, we want to see them going in the same direction in a good, healthy environment and not get too far apart from each other, even though they're on different scales. Gold is still in an uptrend, but it's really not breaking out as of yet. Silver is still in a downtrend and pretty much chopping more or less sideways. We look at the closing price for gold on top and the closing price for silver on the bottom, and then we look at the correlation between the two, and they do have a pretty strong correlated relationship. Then this is interesting because this correlation is actually breaking down a little bit. We take the gold to silver ratio on top, and then we look at the US dollar index in the middle area, and a lot of times they have a pretty strong relationship. So we can follow this and we get some insight based on the direction of the dollar, or using the dollar to get some direction on precious metals. But right now we're getting back down to a neutral area as far as their relationship is concerned. So it's not as helpful to look at this chart right now. The dollar index has been in a shorter term downtrend, a longer term uptrend, and we'll probably continue to see that if stocks still show more strength, because the stock market likes a weaker dollar for export and import reasons as well as conversion reasons. Then we look at the euro, which has been kind of bouncing around a little bit compared to the US dollar. We also keep an eye on the Japanese yen, which has been bouncing back up. I have breakout charts here. This is the euro to the dollar where it has been bouncing back up, but it's still in a longer term downtrend. If we stay above both of these lines, it's going to turn into an uptrend. The Japanese yen has been bouncing back against the US dollar, but it still has a ways to go before we see an uptrend with this currency. The British pound is also above both of the moving averages, but still in a longer term downtrend. Then we look at different indexes, and this is where we're seeing some improvement. The red line here is the equal weight S&P 500. That means that all stocks in the S&P are treated the same. Unlike the S&P 500 regular index, that's the one that you probably hear about all the time, that is a weighted index. And when the bigger companies do better, or when they're moving, they have more of an impact on the value of the S&P 500 itself. And we've been seeing where the red line has been underperforming the S&P weighted index for quite some time. But lately, over the past few weeks, we're seeing a real improvement here. That just suggests that there's a broader base of stocks that are participating in the upward move instead of just the mega caps. This is a ratio of the S&P 500 to the CRB index. So we're looking at stocks versus commodities, where stocks are outperforming, and we've seen a recent golden cross here with this ratio. Here's an inverse of that same chart where commodities are underperforming stocks and a recent death cross. Then we look at the NASDAQ 100 and compare it to the S&P 500, and both are doing really well, but this ratio going up means that the NASDAQ 100 is doing better than the S&P 500. This is a little bit of a concern too, where we're seeing the S&P 100, which has been outperforming for a lot of 2023. It's not really outperforming now when you compare it to the rest of the S&P 500. And this tends to be the big mega caps. So the fact that this is coming down and we're seeing a recent death cross here, that's a little bit of a concern, but it might be being replaced as we're switching this idea of a rising interest rate environment to possibly a falling interest rate environment. And other stocks are going out of favor as more stocks are coming back in favor. But we just want to keep an eye on this. This is kind of a negative divergence compared to what we're seeing in the market right now. Then we look at the NASDAQ 100, which has done well, and the S&P 500, which has done well. But in 2023, the NASDAQ has done even better, and the NASDAQ doing well. But we compare it to the NASDAQ 100, and the NASDAQ 100 is doing even better. Then we look at the mega caps, the really big companies, and compare it with the equal weight S&P 500. And even though it's been in a longer term uptrend and the mega caps have really done well in 2023, they are starting to come down just a little bit. Again, just suggesting that we're seeing a broader based participation of other stocks. Then we look at a ratio between small caps and the S&P. That's the red line. And the fact that this is going up, that could be positive. And this is part of the January effect that I've been referring to. The blue line is the S&P. And when we see both of these going up, that tends to confirm each other. This ratio has a long ways to go to repair the damage that's been done. But the fact that it's even going up is positive. Then we look at another ratio. It's still in a longer term downtrend, but since the beginning of December or so, we've been seeing a real improvement with the small caps to S&P 500 ratio. Then we look at the biggest software companies, and we're not quite there yet. We're just getting ready to see a golden cross here. Another week or so with price above both of these moving averages, and this could turn more positive. The mega caps still continue to do well. They're not doing as well lately, but they've done quite well in 2023. This is the robotics and AI ETF, which is showing some improvement. It had really been seeing some weakness earlier in the year. This is the ratio between the robotics and AI ETF, between that and the tech sector, where it is starting to outperform a little bit, but has a ways to go to really start outperforming. Then we look at the Dow Jones Composite Average, which is the Dow, the transports, and the utilities all taken together. This is seeing the resumption of a new uptrend here, and that's positive. The S&P 500, and then we look at that with a ratio of 1 to 3 year bonds, showing that stocks are outperforming shorter term bonds. Then we look at a broad market measure and compare it with further out bonds, showing that stocks continue to outperform. Then we look at low volatility stocks, which did better in 2022, but they're still in an uptrend in 2023, but they have really been underperforming as they've been chopping sideways. And that's brought out by this next chart, where we're seeing the ratio between the low volatility ETF and the S&P really going down and starting to break below previous lows. We look at the tech sector and compare it with 3 to 7 year bonds, showing that the tech sector is outperforming. Then we look at the S&P and some other stocks. I show this in every daily video, but I like to go through it here since it goes across multiple markets. This is the advanced decline line studies. The top area is the common stock for the NYSE. That's in a solid uptrend, as is the S&P, mid caps, and small caps. Then we look at Dow theory, and this is another area of concern or a warning right now, where if you see this traditional Dow theory here, where we broke out with the Dow, but when you look at the transports, we have not been able to break out above this previous high. That is a negative divergence. We want these two to be able to confirm each other. Now, we don't want to wait forever, but within a reasonable amount of time, Dow theory says that these two indexes should confirm each other. If not, that's a negative divergence. Then what's going to happen? Does that mean the Dow's going to come down, or does that mean the transports are going to go up? We're not quite sure. There are people that are more negative on the market, saying that, oh, look at this negative divergence here, man, things are going to fall apart. Well, and they might. We don't know that, but we need to give this some time. The transports have been under a lot of pressure lately, and they are starting to go back up. But if we don't see this actually start to outperform pretty soon, that will be a sign of concern for us. Then this is a ratio between the transports and the S&P. You can see other times when this ratio is going up, that's when the S&P is doing really well. Well, now we're just kind of chopping around. We do have a little bit of an improvement here as the S&P has been going up. But for this to be stronger, we want to see this ratio continue to go up to give more support to the S&P to go higher. We also look at a ratio between the Dow and the transports, where it's been chopping sideways pretty much for the last couple of months. And we look at the relationship between the S&P on top and the transports, and they do have a fairly strong correlated relationship. When we get a high reading here, that means they're going in the same direction at the same time. This is a new take on Dow theory, where instead of looking at the Dow, we look at the S&P on top, and that's breaking out and coming back to its previous all-time high potentially. And then instead of using the transports, we use the NASDAQ, which that's not necessarily as close to its all-time high, but it's also been breaking out, and we're not really seeing any divergences right now. They're more confirming of each other. Then we look at the FANG index, which recently set a new all-time high, but did fall back recently. And then this is where we broke out and set a new all-time high. So right now, this is still looking good, but we're so overextended with so many of our indicators right now, we're wondering if there might be some kind of a pullback, which may fall over into the FANG index as well. ARC is really showing some improvement. We've seen a recent golden cross here. It's now going up and back into the 50s. And then we look at a monthly chart of the S&P to a European or a world index down here, and showing that the S&P is outperforming. And this other index are stocks in Europe, Australia, Asia, and the Far East. So they try to take a broad representation. And the fact that we're above an advancing moving average shows that the S&P is outperforming. We are turning down just a little bit with our PPO. This is the momentum oscillator, but we're still above zero. Now we look at bonds. This is the total bond ETF, which is showing some improvement as interest rates have been going down. That means price is going up, but we're still in a longer-term downtrend. When we look at world bonds, also still in a longer-term downtrend, but we have been seeing some improvement. Then we look at a monthly chart of the stock-to-bond ratio. We're rolling over just a little bit, but stocks are still outperforming bonds. This is a shorter-term chart where we're looking to see where bonds are underperforming stocks. These are high-yield corporate bonds, otherwise known as junk bonds. They continue to do quite well and are in threat or not threatening, but they may be coming back to test this previous all-time high with this particular ETF. And corporate bonds are also seeing an improvement here. We're not quite to a golden cross yet, but they have been showing some improvement. And then we look at a ratio between the riskier bonds like junk bonds with more conservative bonds like government bonds. And this is falling back just a little bit because we're seeing a change in the overall interest rate environment now. And so this has been really holding up well lately. Folks were willing to assume greater risk to get a greater return. We'll want to keep an eye on this to see if this is going to start coming down, if interest rates are actually going to start to fall in 2024. Then we look at the correlation between stocks and bonds, and they have a pretty strong correlated relationship, meaning they're going in the same direction at the same time. This is the Dow Jones Corporate Bond Index, which is just about getting ready to give us a golden cross here. This is the 10-year yield where we topped out at 5%, and we have been declining overall lately as interest rates have been coming down. This is a longer-term look at the 10-year yield where we're still wondering, are we going through a shift where we might go into an environment of higher interest rates? That's what I was saying as we were going up. But now that we're starting to come back down, we'll have to see how well that scenario is going to play out. We might be going back down into a period of lower interest rates, but we don't know that yet. This is the 30-year yield, which has also been coming down. And then we look at the S&P 500 and compare it with the yield on the 10-year, showing that stocks are really outperforming, even though they're in a longer-term downtrend. The more we can stay above both of these lines, the quicker we'll get a golden cross. Here's the junk bond ETF, which tends to follow the stock market. It has been performing well lately. And we look at junk bonds and compare them with more conservative bonds and showing that this is actually starting to underperform a little bit as folks wanted to get that extra yield, but now that maybe they're locking in longer term bond rates, we're seeing this ratio coming down a little bit. So this has been a shift that we've been picking up on over the last couple of weeks. Then we look at the bond ETF for the 7 to 10 year, which is still on a longer term downtrend, but we're really extreme with the RSI. However, even though we're rolling over with the MACD, the momentum continues to be positive. And this is just a daily chart of the different yields for all the different maturities and how they've been coming down lately. Then this is a weekly chart looking internationally with the US and UK rates, as well as German rates coming down, and even the Japanese rates have been declining. Then we look at the MOVE index on top, which measures the volatility of bonds, then the VIX, which measures the volatility of stocks. And they're actually having a tendency to go in opposite directions right now. They don't have a really strong correlated relationship currently. Then we look at a monthly price chart of the long-term bond ETF, and that continues to be in a downtrend, but it is showing some improvement, but it's coming back up to the moving average. When we look at a ratio between bonds and the CRB long-term, it's still showing that the price of bonds is outperforming. Then we look at different sectors and compare them with the S&P. The material sector is still underperforming the S&P. Communication has been a stronger area in 2023, and that's outperforming. The energy sector, which was bouncing back, is now giving us another cross here, a death cross, showing that it's underperforming the S&P. The financials are finally starting to show some improvement, and we're seeing a recent golden cross here with this ratio. The industrials are bouncing back up, but they're still in a longer-term downtrend. The tech sector has been a stronger area in 2023. The staples continue to be in a downtrend compared to the S&P. Real estate, as interest rates are going down, that will help the real estate sector. It's showing some improvement, but still in a longer-term downtrend. The utilities, they tend to follow interest rates, and they've been going down, so utilities have been going down and underperforming the S&P. And we see this in the S&P to utilities ratio. When this ratio is going up, that usually means the S&P is going up. When this ratio is going down, that means the S&P is going down. We've been chopping around a little bit lately, but we'll wait to see if this is going to break out. And as we see movement in this chart, I do cover this in the daily video. The healthcare sector is continuing to underperform the S&P. Here's another look showing where it's in a longer-term downtrend. Discretionary is just barely coming back and giving us a golden cross when compared to the S&P. It was stronger earlier in the year, and then the summer was not kind to discretionary. Now it's trying to make a bit of a comeback. The staple sector is also bouncing back up a little bit, but still in a longer-term downtrend. The tech sector continues to be in a pretty solid uptrend. The semiconductors also setting new all-time highs and in an uptrend. The tech to S&P 500 ratio shows that tech is outperforming. And when we look at energy and compare it with tech, it shows that energy is underperforming and in a downtrend when compared to the tech sector. Growth, which are the buy low and sell high stocks compared with bonds, shows that stocks are outperforming bonds. And then we look at the tech sector and compare it with the 10-year yield or the interest rate, showing that the tech sector is outperforming on this chart. And then this is an inverse showing where the 10-year yield is underperforming on this chart. Discretionary continues to outperform staples. This is an inverse showing where staples is underperforming or are underperforming discretionary. And then gold is still having a difficult time really breaking out compared to the S&P, and it's in a downtrend with this ratio. And when we look at gold to the dollar, it's trying to break out as we're seeing some weakness in the dollar, but it hasn't quite broken out yet. We look at high leverage loans, which continue to do quite well right now, and that's also suggesting that looking forward, the economy is still looking strong, or at least looking okay. The NYSE composite just came back and gave us a recent golden cross here. That's showing a broad-based improvement. All stocks continue to be in an uptrend. Emerging markets are still in a sideways trend. We're showing some improvement, but we're still in a longer-term downtrend as well. The micro caps are up into the 115 area. We broke down below 100. Now we're showing some real improvement here. And then we look at the home builders ETF. We're not really seeing any real divergences here. They're converging with each other. So they're both having a tendency to go up. So we're not really seeing any warning signs from this chart. Bitcoin continues to be in a longer term uptrend. It's falling back after getting up into the mid 44,000 area. And then we look internationally where China is still in a downtrend, but trying to show some improvement. Emerging markets might be getting ready to turn up. We're negative to sideways with, when we look at Europe, Japan is trying to show a bit of a bounce, and the US is also, with the S&P 500, also could be showing more of an upward move here. Then we look at an intermarket analysis chart going back to the beginning of 2023. Stocks are in the lead, followed by gold, and then the dollar, and then bonds have now turned positive, where energy has now turned negative going back to the beginning of the year. Some correlations. When we look at the S&P 500 and compare it with the dollar, they have a pretty strong opposite relationship to each other. So if the dollar is going down, that means stocks are going up and vice versa, at least for right now. We also look at the correlation between the S&P 500 and oil, where they're having a fairly strong tendency to go in the same direction. That was an issue about a month or so ago when hostilities, actually 2 months ago, when hostilities started to break out in Israel. But now that seems to have settled down a little bit. And then we look at the correlation between the S&P 500 and the 10-year, also going in opposite directions. The tech sector to the 10-year, opposite directions. The S&P to the shorter term 2-year yield, also opposite directions. And then we take some long-term looks at the market. This is the NYSE monthly chart, and we're above the moving average. That's positive. And when we look at the Kopic curve, which is a momentum oscillator, that is continuing to be positive as well. Then this is a daily chart of the NYSE, and we look at the NYSE record high percent index. That is continuing to go up. That is positive. And then we look at the S&P monthly chart where it's above its moving average, and the PPO on this chart is continuing to go back up. That is positive longer term. Then we look at the S&P on top, and then we take a ratio of the S&P to the CRB index, showing that stocks continue to outperform the CRB index. Then we look at another monthly chart of the S&P 500 to another global index. Since we're above the red line and going up, that means the S&P is outperforming. The KST is still negative, but it's trying to cross over positive. This is a very long-term oscillator that we use. So then at the end of the video, I look at all of the positive things and list them, and then the negative things. And my definition of a positive, and it's kind of loose, but I had to make it cut off somewhere. It's when the 50-period simple moving average is above the 200-day simple moving average. So we have the growth indexes, which are a recent addition to this list. Not this week. They came on last week. The CRB index is still in an uptrend. The US dollar index, gold, the mega caps, the FANG index, ARC, the Dow Jones Composite Average. When we look at high yield and junk bonds, the riskier bonds are still in uptrends. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE composite, the NASDAQ and NASDAQ 100, all stocks. And then it might be a little hard to see down there, but Bitcoin is also in an uptrend. Then my definition of a downtrend is when the 50-period simple moving average is below the 200-day simple moving average. And we have the value indexes. Now they're bouncing back, but not enough yet to give us a golden cross. Silver is still in a longer-term downtrend, as is copper, even though that's showing some improvement. When we look at the Japanese yen, the euro, and the British pound compared to the dollar, they're all bouncing back up against the dollar, but not enough to change the trend yet. The dynamic software, those 30 big software companies, they're very close, but still in a downtrend. The low volatility ETF, staples, the total bond ETF, world bonds, mid caps, small caps, and micro caps. Again, if we get that January effect, that could help all three of these areas and eventually turn the longer term trend from negative to positive. Emerging markets are still in a downtrend, investment grade bonds as well as corporate bonds. All right, so thank you. I hope you found this helpful. I also post a daily video. I've also over the weekend posted a weekly video. Then after this, I'm going to be preparing what I call the deep dive video, where I take all the charts that I really didn't cover and go over them in that video. As I record this, it is Christmas Eve. I want to wish all of you a very Merry Christmas, and I will talk to you in the next video.